Hey, everybody, welcome to our next market update for December 27th, 2022. And today we are going to be talking about recession and housing. In our last video, we talked about interest rates, the Fed, inflation, how all of those things are intertwined. And those are really important topics to understand. But of course, the next question is, how does that impact housing? How does housing do? Well, again, if we look at history here, all the vertical bars are recessionary periods. And you can see with the home price index from Case-Shiller, each time there's a recessionary period, home prices are stable or increase every time except during 2007, 2008. The anomaly there was home prices started decreasing before we went into recession. It actually threw us into a recession for a lot of other factors that have no similarities to where we're at right now. So the other reason that we know that housing is going to stay strong is based on supply and demand and new home construction. If you look at these bars here, the white bars are household growth. This is basically new home formations. That is when a new family is formed. Kids move out of the basement, get married, have kids. They need to go out and get their own home. So new home formations tells us how many new home construction units are needed to support that demand, because a first-time home buyer is somebody that is not selling a property, so they're not replacing a piece of inventory when they go to purchase a property. They are taking one off of the market and therefore leaving us with one less housing supply unit to satisfy the demand in the economy. So if we look at this chart here, you can see that back in 2005, 2006, 2007, as the housing market was humming along and everybody thought nothing could go wrong, you'll see that in 2004 to 2005, new household formations actually started decreasing. However, during that time, the colored bar indicates how many annual completions of new homes were done, and builders were building more and more homes through 2005 and 2006, despite the fact that new home formations had decreased significantly. This created a huge oversupply of homes based upon the real demand that was there. There was artificial demand by poor loan products that was kind of supporting things through 2006. But then all the cards started falling in that house of cards, and we went into a huge, massive housing recession. During the next decade, annual completions were still higher than demand up through 2010. Then they basically got level. And then household formation started outpacing new home completions. And we've gotten a huge gap ever since 2018, where there was far more formations there than there was new home completions. Now we're projecting out 2022 and 2023, the new home formations, and we know that these are going to continue increasing based on demographics. Typical first-time home buyer is 33 to 34 years old, and we look back 33 to 34 years earlier to tell us how many people are going to be aging into that age range that are going to become first-time home buyers. That's how we can tell that there's going to be continued increasing demand from new home formations for the next few years. This chart is kind of restating what that other one was. In the circled years, these are the years where at age 32 and 33, and then we go back all the way to 29-year-olds, we can see that there's increasing demand for the next 3 years, and then it tapers off a little bit. But this 5-year period of time that we're going to be in for several years is actually the highest in history. Millennials make up 73 million people in that generation, which is this whole red section here. And it's the largest generation of people by a significant amount that are coming into that age range where they're going to need to buy their first home. If you look at this chart here, this is just kind of a restatement of the previous one. But if you look here, we also look at what percentage of each age bracket is actually homeowners. So we look at homeownership rates. And if you look at the 65 plus, 55 to 64, they're between 75 to 80% of that population owns a home. You get down to the 45 to 54, that's hovering, anywhere between about 70% right now. You get down to the 35 to 44, it's a little over 60% right now. and the under 35 age bracket is actually under 40% of that age bracket are homeowners. So that is the largest demographic of people that exist in our country, and they are the lowest percentage of homeowners of any age bracket in our country. So that tells us that we have a huge demand coming over the next few years from those millennial buyers in that 33, 34-year-old age range that are going to be needing to purchase their first home. And based upon that previous chart, we know that new home completions are not going to satisfy that. We do hear all the time on the news, though, fears about housing bubble. The biggest piece of advice I can give anybody is do not listen to the media. We just pulled some quotes here from Diana Olick, who's on CNBC, and practically on a daily basis condemning housing as a bad investment. Back in October of 2015, she said, housing today, a bubble larger than 2006. If you would have been looking to purchase a home at $300,000 back in 2015 and you'd listened to her and sat out, you would have cost yourself $15,000 because there was 5.1% appreciation rate. If you paid attention to her in August of 2016 when she said we're in a new housing bubble, it would have cost you $17,000. In November of 2017, homeownership doesn't build wealth, the study finds. Again, if you listen to her, it costs you $20,000. September 2018, it's better to rent than to buy in today's housing market. Again, listen to her, lose $14,000. July 2019, the housing market is about to shift in today's housing market. $15,000 loss if you listen to her. December of 2019, next year will be hard on the housing market, especially in these big cities. Listening to her then would have cost you $61,000 in appreciation on that home. And in July of 2021, the housing boom is over as new home sales fall to a pandemic low. That might have been because there was not enough new homes being built, but who cares about the details? That erroneous advice would have cost you $80,000. So you really would have cost yourself $223,000 if you had listened to Diana Olick back in October of 2015 when she told you that we're in a housing bubble and you shouldn't buy a house. So do not listen to those so-called experts. Really dig into the details. And that's why we wanted to talk about this, is give you the actual details to support our view that housing is going to be strong through any recession that we have coming forward. These new home formations typically range around this 1.7 million number. That's going to remain strong. We had a couple of aberrations there during the COVID period. But if you look at the chart here, it's typically right around that figure, 1.5, 1.7 million in new home formations. But people start worrying about, well, what about inventory? Inventory has been going up. Well, yes, inventory has been going up, but it's currently at 1.31, which is quite a bit less than 1.7 million. So there's still a huge shortage there, despite the fact that it's gone up a little bit. But as you can tell from the chart, back to 1983, we're at almost the lowest point in inventory. 2021, I think, was the lowest, but we're at the lowest point of inventory in our history. And America is more than 5 million homes short. This was actually by Diana Olick, so she did give us some accurate information there. There were 12.3 million American households formed from January 2012 to June 2021, but just 7 million single-family homes were built during that time. There is nowhere projected that new home construction can keep pace with the demand for the inventory. And then if we look at the last few months of inventory, we did have that run up in inventory earlier this year that everyone was getting worried about. But since then, the last 4 months back to October have seen a decreasing inventory. So again, we have not solved the inventory problem or shortage. Then you hear about these headlines about foreclosures. Market Watch back in the beginning of the year in March said foreclosures are on the rise, had people starting to talk about that, getting people worried about it. But even in their own article, they did state the truth, which is that the foreclosure figures they were referencing from January are actually 40% below the value that was registered before the pandemic. Remember, during the pandemic, we had foreclosure moratoriums and all kinds of loan workouts where foreclosures were at an all-time low because they legally couldn't take place. So when you start comparing figures, you have to look at the big picture. You saw an increase in 2021 in foreclosure filings. So if you measure it against 2021, yes, it looks like a big increase, but it's still lower than 2020 and well below all the previous years. And if you go back to 2009, 2010, the peak foreclosures We are nowhere near that. So again, you have to have the perspective to understand what these scary news headlines are trying to tell you and step back from them, analyze the details, talk to somebody who is in this world, in this business, and understands it and can give you the right facts and figures. Because at the core of it, real estate is a great investment. Just looking at a $400,000 purchase that you put 10% down, you put $40,000 into it. A normal 4% appreciation rate is $16,000 in profit on that $40,000 investment. That's a 40% return on your money. There's not much else in this world that you can invest in that will actually get you that kind of a return. So there's going to be ups and downs as there is in any market. You have to look at your big picture strategy and how long you plan on being in the house. If it's a short-term strategy, buying may not be a great idea in this time right now, just mainly because of the cost of selling a property. But if you're going to hold on to a property for the long term, it is definitely a wise investment to own real estate. Leveraging the bank's money, even at the higher interest rates that we have today, still gives you tremendous borrowing power and wealth creation power by being into real estate. So please, if you have questions about this, I love to share facts and data to support the opinions. You hear a lot of people in real estate talking about these opinions, that housing's going to be strong, rates are going to come down, but not a lot of people actually explain why. What is the data that we're relying upon? What is the past history that we're relying upon to formulate these opinions? And that's where I wanted to bring you today, is the facts and figures that tell us housing's going to be strong, interest rates are going to come down. If you have questions about any of this stuff, feel free to reach out at any time. Take care.